So I would like to introduce our CEO, Mr. Leon Lei. Can you please come?
Thank you, Michelle.
I'll be back.
Good morning, everybody. Good morning. Okay, let's attack our tax benefits here. Now, for the owning a home, there's so many benefits. It depends on who you are. You are a homeowner or you are the investor. Who have a house already? Who haven't have a house? Anybody here only have two houses? Maybe not. Okay, let's say assuming nobody have a house yet. Myself too. I don't have a house. Okay, so homeowner is here the good thing. We make $100,000, $200,000 income, and you pay tax. Let's say tax bracket, federal and state tax is about 30-35%. Okay, you throw away some money to Uncle Sam, to government, to White House. Okay, White House is still shutting down. Okay, but we still pay. Okay, so the thing is, but if we have a home, we can, instead of paying to the government, we pay to yourself. So some taxes deduction. Let's say $30,000 or $40,000 paid to the government. Now you don't have to pay $40,000 to the government anymore. You may pay $20,000 only, because you already pay interest to the lender. Anybody get it? Okay, just example. Okay. So in the future, when we have a one-to-one consultant with you, we explain more how much you save. But basically, instead of paying to the government, you pay less to the government. Instead of paying $40,000 to the government, you pay only $20,000 to the government for that year, every year, because you already paid the mortgage. That is the tax benefit. Okay, that's one thing. Now the next thing is, let's talk about this one first, and then we go to the next slide. We have more benefits to the homeowner.
Yeah, I say we still pay 40,000, for example, but 20,000 we pay to ourselves instead of pay to the government, right?
That's correct. Yes.
Okay, so
yes.
instead you pay 40 to the government, you pay 20 to them, 20 to yourself. So
Yes.
in a way that you.
Yes, so you save about 20,000 because you already pay interest. Let's say the
This
total
is based on the interest only, right? It's not the
interest only. So interest only. Okay. So let's say we mortgage. We pay if your income. Let's say you pay $40,000. You have income. You pay $40,000 every year. You pay $40,000 to the IRS or state. Now this year, because we just purchased a home, the interest you pay to the government to the lender, certain number. So instead of paying $40,000 tax to the government, this year you don't have to pay. In the total, we will see you pay less to the government because you already pay the interest. That's your expense. Your expense reduce your income, and your income reduce your the tax to the government. Okay. Now, how much is for the homeowner for this year 2019? For the homeowner principal, if you own a house and you're living in that, so up to $750,000 in loan, the interest from $750,000 will be tax deduction.
How many years you have to pay every year? How many?
This is the interest. Let's say if you own a house for $1 million, you get a loan $750,000. That the interest from there, let's see the tax deduction.
Must be 30 years or 25
Every year.
right?
Yeah, if you pay interest, you claim it for tax, and you reduce your tax pay. So in the past, this number is before 2019. There's no limit here. It's $2 million, I believe. But for 2019, there's a disadvantage that you can borrow up to $750,000 and a totally 100% deduction. If you own $1 million loan, then the interest you only collect up to $750,000 only. Okay. Now, but that is for principal only. How is investment form? You can deduct completely. Let's say you have a 4-plex apartment and you get a loan of $3 million loan. So all the interest you pay to the lender is you can be deducted your income because that's an investment, but the business. So business have no limitation, but homeowner, the principal, you have a limitation of $750,000.
This is my from the bank, right?
This is you pay to this is a loan with the bank, yes.
Oh yeah.
But when you claim tax, you file tax return at the end of the year, they will look into the number. It's your home, it's your home you live in, your principal, you can claim up to 750 interest. Okay? Interest from 750 loan. Okay, for investment, there's no limitation. But you own a house, let's say you own the real estate, the building, you can have a tax deduction, and it's the depreciation when you file tax. And it's mainly the other thing is like if you sell home, you sell the building and you exchange for another one, you can have a tax saving too, tax deferral too. Okay, so many things we can talk about another time. Okay, and we can use it for investment. Investment is a new topic, but a lot of people they don't know. You can use your retirement fund to purchase a home. Let's say you have a $200,000 in your 401k. You work in the corporate in the past. I'm sorry, I was too wet. In the past, and then you put it there and waiting for your appointed age, and you enjoy it. You withdraw maybe $10,000 every month for your retirement. How about if you can use that $200,000 in your 401k and invest into real estate and make it growing? And how it's growing? Minh Châu just already explained to you a lot. That's how the real estate growing in the last 10 years, 20 years. Okay. Oh, thank you, Minh Châu. I'm so excited as well. Okay, let's take this one. Deduction. Let's say example here. Let's say we purchase a home at 800. We have a 20% down payment. Normally we get a 640 for loan. So the interest rate from 640 every year you pay out. This will be is $29,000 per year. And here you can claim tax deduction at the end. This is for your principal home. Okay. Anybody do it every year? Is it new? Anybody seen that? Is it normal? Right? Okay. Next one. Now, the good thing is owning a home. Every time you make an income, even $1 or $2, you have to pay tax. That's you. It's in America. Right? America. So United States, you pay tax on what you earn. But owning a home, there's a benefit as well. If you live in a house, you live in there, and in the last 5 years, you live in the house for 2 years, and you gain it, you make $500,000 for a couple, it's tax-free. So if you bought a house at 150, let's say Minh Châu 150 in 1990, and somehow you sell it in 1995 or 1920 and 2000, and you get $500,000 again. Just sell it, move to the next house. Here's a tip. I see a lot of people living in the house for 30 years, 20 years. A lot of people living in Silicon Valley living there for 20, 10, 15 years, and they never moved. If you own a house, and when you see it again, it's $500,000 about that, you better sell, move to the next one. And you don't have to pay tax. And you reestablish the basics. So you bought it for $1 million, and the next 5 years later, or 2 years later, you live in there for 2 years or more, and you live in the house, you get another 500, you have a tax rate again. Now, if people live in the house there, they bought 150 in 1990, and they live it until now. They sell it at $1.6 million, so the gain is $1.1 million. The first $500,000 is a tax free, but $600,000, not $600,000 is a tax deduct, is a tax subject to tax, IRS, and the state. So when we invest in real estate, the government encourages you keep moving up, living there, gain up, sell, move next one. Okay, so they keep that in mind. Okay, so okay, this one is a 500 when I say a couple, but for single, like single people, a lot of people are single here, hold a house, then the gain is 250. And how you define a couple? It depends. Sometimes you don't marry, you don't have a marriage certificate, but sometimes you do. Because it doesn't mean that the IRS or the state, they don't look into the certificate only. They look into how you file tax. And they see the history. When you have a file tax or you claim, or even your companion live in the house, and you can prove they live in the house with you for the last 2 years, it's subject to $500,000. And how to prove it? Talk to your CPA. But we have some tips, but it's a case by case. Any questions so far about tax thing? Yes, and then Brian.
Leon, if you gain is like $500, I mean, deductible, the maximum for two people. So if your house gain is so much, and can you take money for a chemical exchange for the investments? Any?
Okay, good question. Here's the thing. The house, either your principal or investment. We cannot use both, and we can consider it as both. So 1031 is for investment property. So if you live in the house you bought at 500 and now it's $1 million, maybe 1.3, let's say 1.3. So your gain is $800,000. So the first $500,000 is a tax free, the $300,000 is a taxable income. And your question is, can we use the $300,000 there as a 1031 exchange, which means you purchase another home and then get a tax deferral? The answer is no, because your house is the only house you live in. You already have a $500,000 tax benefit. We cannot exercise both at the same time.
So can we use $800 for, I mean, $800,000 for 1031? For investment property?
800,000 again. If you convert the house you live into investment property, then you will use that as investment property. Then you don't have a tax benefit of $500,000, but you have $800,000 again, and use it to exchange another property, buy another one. So either you have to consider this principal or investment. So which way you like? Depends. Sometimes I like principal because even I have a tax-free $500,000, the $300,000 I can use a different way to deduct it. Okay, I repair the roof, I pay commission to the agents, I do this. So it's you have a $300,000 taxable if you reduce this one to 100. So find a way to minimize. That's how we can talk, or maybe the CPA can help you to do it. Kelly.
Yeah, I have a quick question. Let's say you were owner-occupied before and you have so much equity in there right now, but because you have to rent it out for a reason, let's say you gain $1 million right now, okay? Is there possible, do I have to come back and live there as an owner-occupied before I can get the tax break?
Yes, you can do it. Let's say the rule is count 5 years, look back 5 years. That today is 2019, January. So look back 5 years in January 2014, right? So look like, where do you live there? How long you live there? 2 years? If you already live for 2 years, and then, or maybe 2 years you already live there, the last 5 years you qualify. So if you only live only for 1.5 years, you need to stay another half year. So look back 5 years, then you see that we think that you can live there for 2 months, 3 months, 5 months, 6 months total, it's 2 years. Then you qualify for $500,000 if a couple, or $250,000 if a single. So from today, look back 5 years.
So it's not consecutive like 2 years, so you can just break it up like
Yeah, you can break it down multiple times. Sometimes, let's talk about investment. Sometimes a lot of people now, they bought a home for investment, like the Airbnb. And that is a good thing. You can still earn the income, but that's still considered as a principal. If you don't have another house, you claim that's if you claim that's your principal, that is still considered as a principal. You don't have a longer term lease. Now, there's a rule. We talk another time. There's their Airbnb, there's a certain number of days. That's the consumer that live in your home, the renter. It cannot be 12 months. But you can use it as an Airbnb, but it's still considered as your principal. 2 years later, if you get something, you can still sell and earn $500,000 per couple or single for $250,000 for single. Yes.
Say I have restaurant home, right? And how do I make it become my investment? Is that also 5 years, 3 years, then you say?
Let's say today you can decide to convert it into investment home, and you put the house for rent, and you don't live there, and you claim the tax. Here's the thing. Is there no rules to tell you that's an investment or principal? There's no rules. But if we think a reasonable time frame, so let's say if you rent it out for 1 year, then that's considered as an investment. IRS doesn't tell you how many months, but if they don't say it has to be reasonable. So So if you put a house for rent, now next year you file tax return as you put for a house for rent, even though no income, but you don't live there, then that's considered as investment. It doesn't have a time frame. Because you go from the best to the worst, so they don't really care. But if you have investment, you went to climb $500,000, they get very carefully. So from the top best, so nobody wants to convert that one to investment.
The next question is, now, a year from now, I sell that house,
Mm.
right? I want to use all the money I gain from that house
Mm.
for the exchange. What if I next time, tax defer?
Not yet defer, not
defer,
free.
right? Tax defer.
Yes.
I like to change.
Mm-hmm.
And then I want, after I buy the house, I want to convert it, become my resident.
Very good point. The conversion is that the price at the time you convert it. Let's say this big example, and say, okay, he bought a house at $400,000, and now it's at $900,000, and he said, let's put the house for rent for a year to convert it into the investment home. So when he sell, he can use all $900,000 tax deferral, which means you hold on to the tax, and you $900,000 to buy a $1.5 million. Okay, so he said that he wants to convert and leave it there for 2 years or 1 year, and he converted it back to his principal. So he have a tax break. The answer is no. At the time he converted, they calculate the price. At the time you convert, maybe 1.2. So you start from there. Now you still own the IRS, you know, the 500,000 there. They don't forget.
I will make a check.
Oh, good thing. The only thing you can possibly forget, die. Okay, die. So if we own a house, that's a good thing about investment exchange. You exchange, and when you die. Your children, your kids get all, but they don't have to pay tax for that gain. So that's what the good thing is for investment, keep growing, exchange from the smaller one to the bigger one, And one day they die, they have a lot of assets, properties, and all the children, of course, get all.
Today, that's an answer.
But they pay for the different tax.
People laugh, but that's an answer. I say, cheat them.
Yeah, that's good, right?
Okay. Die to cheat them. They have to die to cheat them. So.
Yes. Not cheap, but a benefit, die.
So $500,000 deducted for the couple, right?
Yes.
So if one of spouse died,
Okay, that's a complicated thing. Okay, but one die. Okay. And what happened?
yeah.
It depends how long she died. He died. Look at about 5 years. Yeah, look at 5 years. If she died last year, still $500,000. Because the last 2 years. Now this is 10 years ago. And we can, let's say 2000, year 2000, she died. Or he died. Okay, last time we locked up the price. From the time he began, from the time he bought the couple purchased the home, at the time she died or he died, and that's when $500,000 is benefit free. From that point, for up, it's a taxable. You see, because the die is a debt done from there.
Deceased.
Yeah. Yes.
I think from what I know is if the heir who inherits the property, the basis value will the value that as that current market. So
Yes.
even if the house was bought 5 years ago for 1 million, and when they sold it, I mean the time that the owner died, then the basis value say 2 million, so count from there. So whatever the value taxable on the gain is from that time.
Yeah, but from the time
So
that
now-
you receive it.
Go back to the question from this, if one spouse die, so I think you can verify with your CPA, but I think like 50% will take the value, the basis value of that current price.
Mm-hmm.
Say if at that time the value is 2 million, so then 50% of the property, the value will be at that 2 million.
Yeah, so that we stack up by value.
Yeah.
So let's say we just say we purchased, the couple purchased 500, this is what I say earlier. 500, the time one person died, is a million. Okay, the stamp value is $1 million. And that's why, let's say that the die is a beginning time, not a new life. Okay, for another person, survival. Okay. Okay, let's start from there, 1 million. And that's from 1 million and forever. That is a different number. Let's say that's the future. But from here, from the time you die and the time they purchase the home, that is a $500,000. 250 for this one. This person live for another one. They sell the home, it's right here. $2 million. They still have a $500. They start from here for survival, but for the wife or the husband died, it's from here to here. So we separate them. 250 for the die version and 250 for the survival. Basically, it's fine.
The basic value counting from the 2 million.
For the survival.
Yeah.
For the survival.
For the one who dies. For the spouse who died. Because later on, if you sell that property, so the spouse inherit 50% of the wife or the husband who just passed away, right?
Mm-hmm.
So the time that spouse died, the value 2 million. So the basis value is not 1 million when the time when the property was bought, but at the 2 million. So 50% of the value, the basis value for when you
For the survival?
Yeah.
Survival?
Yeah.
This sort of survival is not 1 million.
No, the 50% of the spouse who died that the husband inherits
Okay.
is based on the 2 million, not 1 million.
So they still have a 250 or 500?
Yeah, I don't know how, but we
250,
counting from
because one person-
the basis, how you pay tax.
Right.
So if you sell at 2.5, so the value at the time the spouse died is 2 million, so your taxable is $500,000.
Okay.
Not 1.5 million, because the price was bought is 1 million. The time the spouse died is 2 million market value, but then when you sold it at 2.5 million, so normally you would pay 1.5 million on the tax capital gain, but since the spouse the time they died at 2 million, so now count from that point 2 million up to 2.5 the price that you sold. So taxable is $500,000, not 1.5. For the 50%.
That's true. That's
Yeah,
true.
for the 50% that you inherit from your
right.
spouse
So
who just
let's,
died.
okay, it's can't go into too much details. We'll
Yeah.
talk later. But basically, yes, when the new life begin, which means when people die, the survival will start the new life, and then the price started from that point.
Yeah.
So it's $2 million, right? And we have to talk about the people who died. So the people who died is they don't have to pay. They die.
I agree.
Okay, we will come back another time, maybe another seminar. Let's move on.
Let's move forward.
So let's say we pay tax. Let's say we have investment property by tax. And how do they tax you? And of course, for the investment, every dollar you make, you pay tax. So the taxes have two taxes. Since we live in California, it's a federal tax, we call it IRS. And the FTB is a state tax, California. So basically, we have to pay two taxes. Just like your income tax, your paycheck, we all pay two taxes, right? So this taxes normally depend on how long you own the property. So we have a short-term gain and long-term gain. And I know that as few people here, we trade stock a lot. So we heard a very familiar term, a name called short-term, long-term capital gain and short-term gain, capital gain. Trading, so I mean the trading stock and the trading, right? So for the short term, it's big, maybe 45%. Let's say you flip home. A lot of people doing flip home here too. They buy a house, they prepare, they flip. So it's subject to 40-45%, and they try different way to deduct it. But for long term, when we talk about long term, it's more than a year, just like stock. It's just a stock, it's just something you trade. House is something you trade. So it's a long term capital gain. Okay. So that is long-term capital gain start from 10% up. It depends on your income. Let's say if you don't have other income, source of income, then you might be at 10%. But normally we put a 20% here. It's just something that's because it's very common. Majority is pay 20% because you don't only flip one property. Maybe you flip two per year. I mean you have another job. You do flip a house, sell home. So normally it's about from 10 to 25%. So we put here 20%, but it's varied. So different person, people, investor, when they pay tax, it's a different rate, not fixed. Not just selling home and you pay 20%. No, it depends on your income as well. It's start from 10 to 25. For the state tax, it's start from 8.3 to I think 14%. So it's in addition to capital IRS tax, we have a FTB tax as well. So the total, a lot of people will say, well, if I sell the home, I gain something, how much I pay? A lot of people just saying to each other on the street, outside, say 35%. Where does 35% come from? It's not from this. Because I pay 20% or 50%, it's just 35%. But actually it's not. It depends on your income. Now, when you sell a home, you might leave the country, you move back to your country, so no good. So normally when you sell an investment home, they have a form for you to fill out. This is investment home or your house principal home, and you say you check the box as investment home. And the escrow company, the third party company, they withhold the money, they hold the money right away, and then they give it to the IRS. And at the end of the year, when you file tax, maybe you have to pay more or you get back, but they collect some money from you at the time you sell home. Okay, it's two rules. It's 3.3% of the amount you sell, or 10% of your gain, depending where you fall. So two ways to hold the tax. 3.3 of the full purchase selling price, or 10% of what you gain. Let's say you buy 500, you sell 1 million. Therefore, if you choose option 10% of 500, this is 50,000. If you choose option 3.3, which means 3.3 of 1 million, this is $23,000. Okay? But this is not final. That's something that would help. Just like your income, you work in a company, you also get your paycheck. Every month you get $10,000, they withhold some money first. It's not final. Right? Okay. So, to answer the question, this is the big topic with many details and exceptions, benefit exception. I just give you an idea a little bit. So we talk another time, potential reaction for investment for investor only. So when you purchase the home, you put it for rent, or you do some, you home it there for vacation, or not vacation home, but for something, for investment, for producing income, we call it investment property. Investment property, that's you will, when you purchase, when you sell, when you buy another one, if you don't want to pay tax, you have a way to defer taxes. You don't pay tax now, you pay later. You use money to purchase a new one. And there is a rule. Within 45 days, when you sell the home, we have to tell the company who hold your money that which property that you're going to purchase. We have a 45 days rule. If you fail to identify the property within 45 days window, then you have to pay tax. And you have another 135 days, the total is 180 days from the day you sell, then to complete the transaction. That's a good thing. That's when you purchase a new home. The new home might not be available right away. But you can tell them that you're going to buy a new home, and the construction might be completed later time. Now, 1031 exchange is not that simple. There's many different ways of 1031 exchange. You can sell the property first and buy another one. With one way that you're going to forward or delay exchange. Another way you can purchase first and you sell later. Because you see something really good investment and you want to buy it. You have a capital, money to buy first, and you sell this one later, but still 45 days. Okay? Then that's called the reverse. And sometimes you identify and you sell it at the same time. We've got simultaneous. And sometimes we have a 1031 exchange that you can buy a home. There's a rule is when you sell $1 million, you have to buy something $1 million or more in order to qualify. If you you sell $1 million, you buy $500,000, then the $500,000 again you bring home, that's taxable. Okay? Now, how to avoid that taxable? Because you sell high, buy low. Then we will have an improvement to exchange as well. You will claim that you use $500,000 to construct a new property. Let's say you buy land. You say your home will be $1 million. You buy the land in Morgan Hill, maybe $700,000, a big land, 2 hectares. But I don't want to pay $300,000 because I sell $1 million. I buy $7,000 of land. So I use up $300,000 to construct the new building there. That qualified too. We call it Section 1 chain improvement. Okay? So there's another thing, but this is we will talk with any of you. Yes.
So is that two-step have to be, is that must two-step? I think within 45 days you say, I filed a property. And then within 180 days I have to close it.
Yes.
Or I don't need to do the first step as long as I close.
We have to meet two.
Two must have two.
Yeah. So timeline from day 0, we close the transaction, you sell it. You have 45 days here, and within from there to here, 45 days, then we have to identify the properties. Maybe 3, maybe 1, 2. Maybe.
How do they know?
You tell them.
You have to tell them.
You write an email, fill out the form. I found 3 properties. I lied. I will close one of them. Or I can close, if you sell $1 million, you buy 3 properties, 300, 400.
But you have to tell the bank?
Tell the company who hold it, we're going to transfer exchange intermediate company. The company who qualified, authorized the IRS to hold the money. You're going to take home, just like 401k, a stock, a bond. When you work for the company, you have a 401k benefit. When you move to another company, we got to roll over. Roll over has to roll the money from another company, 401k plan. You're going to take home.
But let's say if I identify the house A, but actually in the end I buy the house B.
But the B is in the list or not?
No.
No. Then the B has to be in the list within 45 days. Let's say day 45, oh, I have another house. What B? I never identify. But if you identify A, B, C, and over the day 90, you say, I have a property C, F. No, it's not, doesn't. I know. They have to be within. The how you complete the transaction has to be identified earlier. Okay.
If you say that we bought the house before we invest for the change, so how can we play?
Oh, good. So let's say you have cash. You own a property, you want to buy the building in downtown San Jose, and you want to exchange, but you don't have time to sell this one yet. You don't have a buyer yet. You want to buy the other one. So you have to use different money. You have temporary money somewhere. Okay, you buy the building in San Jose. Within 45 days, you have to sell this building you have. And you ask money to show to the other one. I say, hey, I have money now. So it has to be